What is company car tax and how can you reduce it? What is company car tax? A company car is an extra benefit provided by your employer and is known as a benefit in kind tax. When you're given a company car, the cash value of the car is added to your salary. A tax is then taken off the final sum. Unfortunately, this could raise your rate of tax if you're close to a tax threshold. You don't pay tax until you're earning over £10,600. When you start earning more, 20% tax is paid. There might be times when the cost of your company car tax takes you up and over your budget. It's all well and good getting a car on a great discount, but if it costs you a fortune in company car tax, is it really worth it? At times, people are advised to lease privately rather than through their business because the company car tax is so high. But there are ways around paying so much money in company car tax. How much tax will you pay on your company car? The amount of tax you'll pay on your company car will depend on variable factors. These factors include how much you earn annually, the CO2 emission bracket of the vehicle, and the P11D value of the vehicle. If the vehicle runs on diesel, you'll incur a 4% surcharge, but if your car requires petrol fuel or runs on electric, the extra charge is waived. Your vehicle will fall into a CO2 emission band, which has been carefully designed to align with the worldwide harmonized light vehicle test procedure. The WLTP came into force in 2017 and overtook the theory-based New European Driving Cycle, or the NEDC. It uses driving data to assess on-road performance and calculates the fuel efficiency to see how much CO2 is emitted. As of 2019, all car dealerships will have WLTP COZ values and all taxable incentives will follow suit. How to calculate company car tax? To work out how much company car tax you'll need to pay, HMRC will first consider how much CO2 your car emits. This will fall into one of the 18 emission bands above. The lowest band starts with vehicles that emit 0 to 50 grams per kilometer. The amount you'll pay will appear as a percentage, and you'll notice that the diesel percentages are slightly higher than petrol, as there's an added 4% of surcharge for diesel motors. This percentage will be multiplied by the recommended retail price, RRP of the vehicle, which is often referred to as the P11D amount or value, which is calculated using a makeup of certain costs associated with the vehicle. You can see how to calculate your P11D value here. HMRC also offers a comprehensive calculator that you can use to help you work out how much tax you'll need to pay. Why do you still have to apply to tax your tax-free car? By not applying to renew their road tax, owners of cars that qualify for free VED are caught out even though they don't have to pay the levy. Many low-emission vehicles that were first registered and emit up to 100 grams per kilometer of CO2 before 1 April 2017 qualify for free VED. Drivers of these vehicles, however, will also receive an annual reminder of renewal and must register for road tax even if there is nothing to pay. Ignoring the notice of renewal runs the risk of a fine up to £1,000. Last year, reports showed that over 71,000 individuals failed to tax their zero-rated cars over the previous 3 years, resulting in penalties of more than £1.1 million. The DVLA requires every car to be either taxed, even if it's free, or declared off the road by filing a statutory off-road notification every year. It claims that this ensures an up-to-date record of car ownership in the UK and whether those cars are being used on the road. How can you reduce your company car tax? First, you got to learn how to reduce your P11D value. There are ways to reduce the P11D value, and that's simply to get a car that costs less. If you don't want to compromise on the model, then reducing the number of additional extras will bring the P11D value down. But if you seriously want to save on company car tax, then the lower the P11D, the better. The second factor in determining how much company car tax you pay is how much CO2 your car emits. This is pretty much the main factor in calculating your company car tax. The main way you can lower your company car tax is to get a low-emission vehicle. There are changes to company car tax, which means from next year, you will not be able to get a company car that is completely exempt, but you can still save a lot of money on company car tax if you got a lower emission vehicle. If you want super low company car tax, then you want to go for an electric car. These are zero emissions and will be taxed at 2%. However, this isn't viable for everyone. So the next best thing would be cars that emit between 1 gram per kilometer and 50 gram per kilometer. The amount these cars will be taxed will be between 2% and 14%, depending on how many zero-emission miles the vehicle can travel. So another great way to reduce your company car tax would be to invest in a low-emission car. One of the reasons for these company car tax changes is because low-emission cars are becoming so popular. So looking for a car with low emissions isn't half as difficult as it used to be. There is a low-emission car for everyone, from city cars to executive salons to vans. Another thing you can do to reduce these taxes is by putting in a CO2 cap. Capping CO2 emission that company cars produce can help to keep tax low, because benefit in kind tax is determined by the CO2 emissions and the car's list price. Making cars available via a salary sacrifice arrangement can also help employers and staff save money, but it is vital that employers emphasize the savings to employees. The use of CO2 capping is increasingly frequent, ensuring only cars below certain emission levels are chosen. Limits are often linked to a government policy. Caps of 130 gram per kilometer are commonplace. This limit ensures drivers' BIK tax is no more than 25% over the next 3 years under existing rates. Employers can also benefit because they can keep national insurance contributions down, which are linked to the car's price. In addition, introducing green cars into a company car scheme could potentially increase take-up among employees and help address CO2 output. Electric cars and plug-in hybrid electric cars offer the most significant savings to their ultra-low or zero CO2 emissions. A company car being a green car is directly linked to its fuel efficiency and miles per gallon capabilities, so there are real savings to be made. Environmental factors are becoming part of the choices employees make about cars. Government policy seems to have pushed manufacturers into selling more green cars. These cars are nowhere near as restrictive in choice as they were a few years ago. Such a broad range of green cars being on offer gives employees much more control. More electric cars are also being sold, which is driving their price down and making charging points more widespread. Even the lowest emission cars will be subject to tax rises over the next 5 years, but as manufacturers strive to reduce emissions, company car drivers and employers can look to maintain tax rates that are similar to or lower than the current rates. And with just 16% of employees considering an electric car as their next company car, according to research by the Lease Drive Group released in March 2014, there is clearly more that could be done around highlighting the benefits of green cars to improve tax savings. However, another thing you can do is share a car. Sharing a car reduces the benefit each employee pays tax on. The value of the benefit for each employee is reduced on a just and reasonable basis. For example, if 2 employees share a company car equally, normally each of them would be taxed on half the usual benefit. If the employees are also taxed on fuel provided for private use, the value of this benefit is reduced in the same way. Also, you have to keep in mind that some companies offer employees extra salary instead of a company car. This is worth considering if the company car has high emissions. The number of miles you drive on company business no longer reduces the tax charge, but it will affect your running costs. Adding to that, some companies provide benefits for employees who use their own cars for business. These are normally paid as mileage allowances. The size of the allowance will be decided by the company. Companies may decide to pay the optional passenger rate of up to 5p a mile for each passenger. The passenger must be an employee who also needs to travel on business.